My name is John Jimenod, Regional Vice President of Sales here at Angel Oak Mortgage Solutions. Today, we're going to dive deep into products. We've had a lot of changes. We're not going to talk about how Angel Oak is vertically integrated, how we've done over 25 securitizations. We're not going to talk about the 37 enhancements. We're going to have our subject matter experts talk about all of our recent enhancements and how they can help you close more loans. So without further ado, I want to introduce Denise Mcconnell. She's one of our talented, high-producing account executives out of New Jersey. Denise, say hello.
Hi, everybody. Nice to see everybody. Just wanted to say thank you for having me today. I've done this once before, and I think it's just such a great thing that Angel Oak puts out. Just want to let everybody know that prior to my wholesale.
Oh, froze up there a little bit, Denise. Give her another couple seconds to get unfrozen.
Here at Angel Oak. Career, I was, I'm sorry?
No, Denise, you froze there for a minute. So technology,
I don't know, I can't hear anybody.
There for a minute. So if you could just, prior to your career at Angel Oak, that's the last thing I heard.
Uh-oh. Oh yeah, so I've been with Angel Oak for about 3 years, but I've been in wholesale most of my career. But the position that I held right before this was actually a loan officer's position. So I feel like that is a real benefit to my referral partners because I sat in their seat, you know, for 7 or 8 years, knowing exactly what they go through on a daily basis, knowing how difficult it can be to, you know, reach out and want to broker a loan and not do something in-house.
And just for the record, Denise is playing a little under the weather today, so we really appreciate her stepping up today. So, and then our next subject matter expert, Gary Martinick, he's out of the Maryland area. Gary, please say hello.
Hi, everybody. Thanks for having us here. Look forward to the opportunity to talking to you guys today. And like Denise, well, I've been here actually 6 years now, and I've been in the business actually. This is my 29th year. I hate to admit that, but for like the first 12 or 13 years of my career, I was in retail as well, which I think helps because it allows us to see what you guys are seeing and help you structure loans to get them through. So I think it's kind of a benefit when you've been on both sides of the fence and sitting where you're sitting right now to help, so we can put ourselves in your shoes and help you structure a loan.
Yeah, so not only you have subject matter experts here at Angel Oak, but you got mortgage professionals with really, really broad experience. So hopefully today we're going to teach you how you can help you guys close more loans. That's why you're taking, an hour out of your day to learn to learn more about these programs and then to learn how to capture more of these type borrowers. So without further ado, we've already got a question coming in here. What makes a non-QM loan different from a QM loan? So I'll go through that, the highlights there. We still have to abide by the ability to repay. That's, under the CFPB. Points and fees, 3% are the max fees for an agency loan. We could go up to 5% fees for non-agency, non-QM. And then restrictions on loan terms. Not interest only on agency. We allow interest only, and we'll talk more about our interest only program here. So, and then DTI is usually the last thing that differentiates agency from non-agency, non-QM. 43% debt to income ratio, and we're allowed to go up to a 50% DTI. So guys, please use that question box. Again, as I mentioned earlier, this is going to be recorded, so we will get this out to you before end of day today. But let's dive right into products. That's why you're here. But before we do, Gary, I know you were going to catch me here. We're going to launch a poll, and let's launch the poll right now. And the question is going to be, I think our one of our assistants is going to launch that poll for us. The question is, we really want your participation. Who has closed a bank statement loan within the last 12 months? And we'll keep this open for about 10 seconds. Let me see. Give it another couple seconds before we let Gary go into the highlights of our bank statement program. Okay, let's close the poll. I did not see what the poll results were. I don't know what happened here.
It says 31% yes, 69% no.
Wow.
Wow. Okay. So we've been doing this. This is our 14th product webinar. So we're moving the needle, guys. We're moving the needle. It used to be only in the 20s. So 31% of you, congratulations. But let's talk about the 69%, the huge opportunity. Gary, go ahead. Give them some highlights here.
So this is actually just about my favorite program to talk about because there's such a need for this particular program in the industry, because I'm not sure if a lot of people realize it, but there are at least as many, if not more, people who are self-employed in this country than veterans. So let's say, and the amount of people who are out there who don't know they can qualify for a mortgage loan because they're self-employed in the way they file their taxes is pretty high. So this is the perfect way for somebody who's self-employed and can't qualify the traditional way through tax returns to qualify for a mortgage loan, or to really determine what their true buying power actually is, because they may have their heart set on, $1 million property, but if you look at their tax returns, they don't qualify for nearly the amount that they wish they could. So some of the requirements for the bank statement loan are you have to be self-employed for 2 years. Now, we do loan amounts starting at $150,000, and we go all the way up to $3 million. So we can go up to 90% loan to value in many cases if you have at least a 700 FICO score. But we start, and you mentioned this before, John, with some of our enhancements. Recently, in the last couple of months, we just made an enhancement where we'll go down to a 600 FICO score to start with, which is very, very aggressive. So we can either do personal or business bank statements to qualify. The difference is, with personal, you have to just meet the technical definition of self-employed, which is owning 25% of the business. If you want to use business bank statements, you have to own 50%, which is still very, very aggressive. And we can either use 12 or 24 months worth of bank statements. It's really choice. The only difference, there's no difference in qualification, just a slight difference in rate, where the 24-month bank statement option may be a little bit better in price, but not that much. So what was I saying? Okay, so when I mentioned we could go up to 90% LTV, one of the things we can do is we can go up to a $2 million loan amount. Even though we go up to 3, we can go up to $2 million loan amount with a 700 FICO score, all the way up to, up to 90% LTV with no mortgage insurance on that as well. Some of the questions, and I'm sorry if I go off script a little bit here, like a lot of the questions that I get are for especially someone doing their first bank statement loan. They'll call me and say, well, do you have a worksheet where I can determine how to calculate the income? And we really don't, and the reason we don't is because we have an underwriting team, a bank statement review team that does nothing. Their sole function is to calculate bank statement income, right? So how do we do that? So we take that off of your plate. You send us the bank statements. We actually do that for you. So we're really concerned about the cash flow of the properties of the business. So that's where this is a big advantage over, say, looking at tax returns.
Yeah. So one of the things, Gary, sorry to interrupt, but one of the things, Gary, I really want to emphasize, and you jumped into it probably sooner, but it's really, we have a team of experts that's going to calculate that income for you. So Denise or Gary or any other of our AEs across the country are not going to issue a pre-qual until your borrower has that income and they know what they can go shopping for. And Gary also touched on this a little earlier. If you're going off tax returns, that borrower may only qualify for a $300,000 house. And at the end, when we do the bank statements, maybe they're qualifying for a $900,000 or $1 million, as Gary said. So we're increasing that purchasing power almost 3 times. And I've heard in some cases 4 or 5 times. So sorry, Gary, if you could go through the rest of the highlights here. I'm sorry, but sure. I thought you hit on a great point though. So sorry.
Just to touch on that, just a little bit more on that, which is, since we're doing this up front at the pre-qual stage, or we call them quick quals, and you have a TBD property, now you have a borrower that can go out confidently shopping for a property, knowing that the income has already been underwritten before they ratify that contract. So we do all. The other thing that I get asked a lot is, do we apply expenses? I mean, what are we looking at? Are we looking at 100% of deposits? Do we apply expense ratios? The answer is yes. When we send it to our bank statement review team, and there's some nuances to this, but when we send it to our bank statement review team, they're going to default to a 50% expense ratio, meaning that if the deposits, let's say, equal $1 million over 12 months, if we're doing a business 12-month bank statement loan, then we're going to give them credit for, say, $500,000 worth of verifiable income divided by 12, and that's their qualifying income. There are some exceptions to that. We can get that down from there depending on the business, right? I mean, if it's someone who works from home or has a very limited overhead and we get a CPA letter, we can get that down as low as 30 or even 15% sometimes if we need it. But the vast majority of loans actually qualify at a 50% expense ratio. So we do that right up front. So when we pre-qual the loan and get it back to you, you're going to know at that point what you can put on your application, or what you're available to put on your application is qualifying income. So I think that's a big advantage when you're talking about this particular program. As an example, I just had one example I want to give, if you don't mind.
Yeah, go ahead.
I had a loan a month or so ago. The loan officer had unfortunately miscalculated the income. It was a large loan. It was over $1 million, and the debt ratio was blown. They sent it to us. We had about 2.5 weeks to get the loan closed. The way we calculated the income, even though they didn't qualify for a full doc loan, our back-end debt ratio using bank statements was 14%. So we were able to get that loan closed, and it was definitely a lifesaver for the loan officer. I'm sorry, you were about to say something, John?
Yeah, no, so Gary, so I'm gonna, again, everyone we got a lot of questions coming in here, so we're gonna try and get through them all. If we don't, we're going to have your local account executive reach out to you. So first question, and Gary, you might get this in your neck of the woods up there. Steve's asking, you know, he's got a realtor looking for a second home, but wanting to use bank statement. What's the maximum LTV for second homes using bank statements?
Well, we can go up to 85% LTV using bank statements for a second home, or investment is you know, if you want to use bank statements. So we can get fairly high on the LTV. And once again, I mentioned it earlier, but if we go above 80% loan to value, there's no mortgage insurance on the loan as well.
And Denise Lewis is asking about, you know, will we do the calculation? And Gary might have touched on this, Lewis. So, you know, will we do the calculation before the loan being submitted? You know,
absolutely. Denise. Absolutely. You know, before we put a quick qual out, we want to make sure that you know exactly what type of income we're using for that loan. We want to make sure that before your borrower goes shopping for a home, that, you know, that we have a working income figure. So our quick qual will tell you the income that we're going to be using for that particular loan. And you'll have access to the worksheet as well to see how we came up with that information.
Yeah. And Gary, you know, maybe we didn't really talk too much, but touch on for Evelyn on 1099 borrowers and how those work.
Yeah, so 1099 borrower, the program that we came out with, and that's a recent program too, within about the last year, is perfect for folks who are contract employees, real estate agents, insurance agent, or, you know, if they're part of the gig economy where they're contract employees. We can use, the way it works is we can use either the last 1 or 2 years worth of 1099s. Use the gross income off that. We'll apply an expense factor to it depending on the time of the year that we're in. We'll also get, if the borrower can provide it, a year-to-date earnings statement or year-to-date bank statements, and we'll calculate it, you know, based on their income with an applied expense ratio. But it's great for people who are contract employees. They do have to have a 1099. They do have to be employed with the same employer for 2 years. And it's a great program to use for your realtor partners.
Yeah. Gary, you hit on that. I mean, if you're a loan officer and you're trying to prospect for the self-employed borrowers, I mean, you're going to start with the realtors, right? I mean, and not only that is you're going to educate them about those programs, and then you're going to increase your referral source. So that's a win-win-win. So another question here, Denise, that came up. What do we? Any property restrictions, Denise, on this?
Meaning what?
I'm gonna guess it, you know, 1 unit, single family, condos, you know, let's give them,
yeah, you know, on all products we do 1 to 4 family and condos. We actually even do non-warrantable condos with this program as well. So no restrictions. Obviously we're not doing anything that's like mixed use or anything like that. So it's residential 1 to 4 condos and non-warrantable condos.
Yeah. So Richard, hopefully that answers your question. Also, I know you talked about a property, Richard, in Tennessee and possibly doing rural. We really, anything over 10 acres in rural, you know, I would say let's dive into that a little bit more. Also, one of the things I really should have opened up at, what makes Denise and Gary experts in what they do. 30% of the loans we close here at Angel Oak don't meet our guidelines. So really don't say no. Give Denise a call, give Gary a call, give me a call, give your AE a call. They will take you through it. They are experts. Gary's got 6 years. Denise has 3 years. They have seen everything in every scenario. So I would say don't ever turn down a loan. Call your Angel Oak AE, and they will definitely tell you if it's a deal they can do. And more quickly, they will tell you if it's a deal they can't do.
That's an excellent point, because I don't know that a lot of account executives have the ability to work directly with an underwriter at the pre-qual stage. I think it's really important to get exceptions up front, and not something that we address anything up front. So it's very important to give us all the information that we need. We can address, something that we think might be concerning with an underwriter up front, get that exception up front before we even start the loan process. And I think that that's a huge benefit, that when Angel Oak gives you that quick qual, that's pretty much insurance, barring any, strange thing that might happen or an appraisal issue. That should be a done deal.
Yeah, I think, as this space continues to grow, Denise touched on it, and I touched on it in the beginning. I wasn't going to talk about it, but it is our vertical integration that makes Angel Oak why you want to partner with Angel Oak. You're not going to partner with someone who's maybe a pass-through and they have to, after you get the clear to close, and all of a sudden you're going to get 2 or 3 more conditions, or someone's going to calculate that income differently. You're working right up front. We know how important those referral sources are to you. So we really, we take that seriously. We want you to grow your referral source, not, decrease your referral source. So a couple other questions coming in here. Edmondo, we're going to get to the rates here in a little bit, so bear with us. Roseanne knows that there's flyers out there. Roseanne, stay tuned in the end. We're going to really teach you how to get to these borrowers. And so Bob Martinez is asking here, Gary, do we issue the pre-approval letter?
Well, we issue the quick qual, which goes to the loan officer, and from there, if they want to issue their own pre-approval letter on their own letterhead, that would be great to do. But I would wait, obviously, to offer the pre-approval letter until you get that quick qual in your hand. But one of the things that we do, and I know Denise does as well, and we all do here, is that when you get a quick qual from us, there are going to be some canned requirements, for every different program, but we're also going to put our own comments on there. Mm-hmm. So if we see something on there that we want you to be aware of, like you're backing up against a tight debt ratio or something like that, we're going to tell you to keep an eye out for something like that. Or in this program, something that I do all the time, John, is in big bold letters, I say, whatever you do, do not submit tax returns on this loan if it's a bank statement loan. That's not going to help. So just make sure that that's nowhere near this file. So we do add our own comments to this to make sure that, you avoid any potential landmines that you could find.
Yeah, and Gary, you touched on it. I'll ask Denise the question. What's our DTI on this program? Denise had a few questions on that. You might be on mute, Denise.
The DTI is 40 front ratio, and no,
40.
I'm not. Can you hear me?
Yeah, I can hear you now.
Yeah, 40 in the front, 50 in the back.
Great. Heard that. Thank you. And then Gary, if you could just talk a little bit about, I saw this question coming in here. Give us examples of partial ownerships, Gary. You talked on it. You have to be 25%. Talk about this, Gary. About what if the spouse is W-2'd?
That's a good question. That's another question that we get all the time, because a lot of folks out there, if they're doing their first loan or two, they ask the question, if I have someone that's bank statement, that's self-employed, and let's say it's a spouse that is a wage earner, can we use their income? And the answer 100% of the time is yes, we can use it as long as they meet the FICO score requirements. But yeah, we can do a combination of business and personal bank statements and a wage earner. We're going to underwrite it as a bank statement loan, but when if somebody gets a W-2, we'll pull a 4506 just on those W-2s, not the full tax transcript. And we can do a combination between the two. We do it all the time.
Great. we got some people helping us answer some of these questions. Just a couple other questions on, trying to think here. We talked about primary, second homes, not owner occupied. Gary, you touched earlier about we'll go down to as low as a 600 credit score. Gary, what's the max cash in hand? You know, we're getting a lot of people who have, and then Denise, I'm going to come to you about our interest only. Gary, talk about cash in hand. We know a lot of people have seen appreciation values and their properties go up, and a lot of self-employed borrowers are looking to maybe reinvest in their business. Please touch on some cash out there.
Yeah, I mean, this is another aggressive change we've made in the recent past here, but now we can do, and I'm just going to refer because we have different tiers here. So I'm going to refer, don't mind me putting on my readers here. I'm going to refer to my matrix here just to make sure I get the amounts right. But the max cash in hand is $1 million. Okay, so if you're 500,000 to $1 million, a 60% LTV max, we can do 500,000 to $1 million. And if you're going to get cash out greater than 300,000 cash in hand, you need a 700 FICO score. So we do some aggressive loans when you're talking about how much cash a person can actually get out, of their property. It's quite a bit.
And again, as I mentioned earlier, those are just guidelines, right? You know, we'll get exceptions. If the LTV is super low, we might go higher on the cash out max. So Denise, talk a little bit again. Self-employed borrowers love cash flow, right? So talk about our interest only feature.
So that's another, just for a very small rate bump, the borrower can actually take a 40-year fixed interest only loan. So it's interest only for the first 10 years, and then it's basically a 30-year payout. It's a benefit on most of these jumbos. We're going to have a certain credit score and LTV requirement for that program, but it's just another add-on to our fixed rates.
Yeah. Someone talked about, the vertical integrate. It's a company that owns us, so it's our capital company. So we're not going to a third party to purchase these loans off there. And I don't want to. This is about product. I told in the beginning we wouldn't talk about our vertical integration. So we're going to jump on. We've been here for about 25 minutes on bank statements. It is our most popular program. That's why we do love to spend time. And there's a ton of questions. We really, really appreciate the audience participation here. We're going to talk about our second most popular program. But before we do that, we are going to launch another poll. And before we get to our investor cash flow, we're going to do a poll here and see how many people have closed a investor cash flow, or as a lot of people refer to this as a debt service coverage program. So we're going to spend about 10 seconds. We're going to launch the poll for our debt service coverage. Who has closed a debt service coverage ratio program in the last 12 months? Give it a few more seconds. Love this participation here today. Still collecting responses. All right. This has been pretty much in line. Go ahead.
This is great.
Yeah. What did it say? 21% have, and
yeah, 79% of the people on this call have never closed a debt service loan.
Yeah. So Denise, give us some highlights of it. I mean, this is just a huge opportunity.
Absolutely.
Yeah. So go ahead.
So I'm glad I'm talking about this product, because when I first started working for Angel Oak, I remember thinking this product was just too good to be true. I mean, coming from the retail world and coming from, an agency loans, anytime I had to do investor loans, first of all, there was always a substantial down payment, but there was also so many other things, a certain amount of properties that they were allowed to own, couldn't close an LLC, reserves for every single property that they own. So there's so many different things here that I love about this program, but it ended up not being too good to be true. It just ended up, after 3 years of lending on this product, it's just too good. So I'm glad that most of the people on this call have never, don't know much about this, because this is going to be an eye-opener for you. First of all, you'll see you see that we're going to be calling it a Dscr loan, and that's debt service coverage ratio. This loan is for investors. This is for somebody who has an established primary residence and is looking to buy some investment properties. This is a no income, no employment, and no traditional DTI loan. So what we're basing this on is the rent roll of the property versus the pity payment. So as long as the rent is covering the pity payment that is being requested, this loan should debt service. We also have introduced, I mean, we're doing loans here from 75,000 up to 1.5 million. And again, we do make exceptions. We don't make exceptions under 75,000, but I do know that there is some restrictions in the market, and 75,000 is actually very good, because I think there's other competitors that are at the over 100. Also too, we introduced a no debt service coverage loan. So for borrowers that have excellent credit of 700 score and higher, and with a little reduction in the LTV for single families, we're gonna give you 75 LTV, and we'll be able to do this loan with no debt service, with a no debt service coverage. So in other words, it's typically for properties that don't annualize well. In other words, say you have an investment property that maybe is rents weekly in the summer, and the annualized rent is going to kind of put you out of the debt service. Because if we look, what we're basing this loan on is the appraiser going out and telling us what this property will rent for monthly. So if it's a property that could command like a beach house or something that could command weekly rentals, obviously it's not going to debt service. So that kind of debt service, no debt service coverage will cover those loans as well, wherever it falls out, or if it falls out slightly. The good news is you can close these loans in an LLC. There's really no landlord experience here, but we are looking for somebody who has a primary residence, a good mortgage history, solid credit. So we are basing it on that, but we don't look at income, we don't look at employment, and again, there's no debt, there's no DTI. There's no limit to the amount of properties that this borrower can own. So that's really important, as we'll be able to do up to, I think, 5 or so. It really depends on the cumulative loan amount for one borrower. So say you have a borrower who's a very experienced investor, he already owns several properties, he's not qualifying now for an agency loan. This is a slam dunk for us. And these loans move really quickly because there's really not a lot of documentation. Again, we're not having to verify the employment, we're not having to do the income. So it does move relatively quickly. Again, the LLC is a very big selling point. We typically want maybe only 2 borrowers in the LLC. We have made exceptions with married couples and being one of the entities. Other than that, the property will be done in the property will be vested in the LLC, but the loan will be done in the personal name. I pointed out reserves. These loans do require 6 months of reserves. If it's a cash out refi, we actually allow the cash to be used as reserves. So that's a big help there. But for a standard purchase, we would require 6 months reserves. But again, that's only on our subject property. So I don't need reserves for the primary, and I don't need reserves for any other properties that they own. Again, this is a property that we're looking for, a typical investment property. We want the primary residence should be superior. We want to make sure the borrowers may be living in a single family, maybe looking to buy a 2 to 4 family. We do single family investors as well, condos and non-warrantable condos here.
So it's a lot of questions coming up. Obviously, Denise, great job recapping of what we'll do. Gary, first question out of here is prepays on investment property.
Yeah, we do charge a prepayment penalty where they're allowed, wherever the state allows it. Typically, the prepayment penalty is going to be a 3-year prepayment penalty, but that can be bought down or bought out completely, either through the rate or through points. So we can buy the prepayment penalty out, but they do come with prepayment penalties wherever they're allowable.
Yeah, so then, and then you mentioned this, Denise, talk about refis and cash outs on this program too. So, how we're allowed to. Yeah.
Right, we can do purchases, we can do cash out refis, obviously, but we will allow the cash out to be used as reserves. So that's a big selling point as well.
And seasoning on cash out, how long did I have to own the property for
6 months.
Yep.
So we'll be starting to look at the appraised value at the 6-month point. Keep in mind on most angel loan products, you know, we do offer delayed financing for anybody who may have paid cash for a property. We know this is a very competitive market right now, and we understand that some people, in order to obtain a property, are depleting maybe the cash that they have. And just understand that you know, with that, from that purchase the date all the way up to about 6 months, actually even longer than that. If they pay cash for the property, we will come in and we will look at it like a purchase, and we will do delayed financing. Most important on this is that the borrower does use their own funds for the purchase. It would have to be 100% of their own funds, and that it would meet the standard purchase guidelines.
Delayed financing is huge, especially in these hot markets where we all live in. I mean, it's the entire country. Every market's hot, multiple bids, and therefore some people have to pay cash, and they want to basically reimburse themselves for that out-of-pocket of purchasing that home. And we can do that, you know, across the board on all of our programs. One of the things I wanted to bring up, one of the account executives in the Tampa St. Pete area, she had a borrower that had 10 properties that were hard money. They wanted to get them out of hard money, do cash out, and then go purchase additional product. We were able to do that because the LTVs were low. So Denise talked about, you know, 5 properties, maybe a $2 million exposure. Again, these are just guidelines. You know, work with your individual AE and get something, you know, again, at the pre-qual level, we're going to do that. One of the other things I did want to mention, you know, midway this year, agency loans had put a cap on, you know, how much of your portfolio can be non-owner occupied and second homes. And then they put a lot of loan level pricing adjustments on that. And this product for us really took off. And we saw a lot of people just stay with us because our rates were really aggressive. And we don't know if that lift on that 5%, 7% of your portfolio or those loan level pricing adjustments, we don't know if they're going to come back in 2022. So stay tuned, but hopefully 79% of you will close a loan and realize that when those temporary lifts on those come back, you'll be able to know how to close loans with us. So let me be quiet. And Christine, we're going to talk about a great tool we have, Quick Quote, that will show you a couple examples of some pricing tools. And couple of other questions. Obviously, there's no DTI on this. And I think, Gary, you might have talked about what's the lowest score that we'll go down to for the highest LTV on our investor cash flow program.
So the lowest score that we'll go to on ICF on investor cash flow is 600. And that 600 will go to a 70% loan to value. And it goes up from there. So if you have a 660 FICO score, then we can bring it up to an 80% loan to value from there. And then it's 80 max across the board.
Yeah, guys, I mean, we're all checking sheets here because everything has changed. I mean, we are, and stay tuned, we'll probably have some more enhancements in the next, you know, months to come. So Denise, let's talk about one of the other enhancements we rolled in this program under our investor cash flow debt service coverage. You could touch on please.
Well, we were very happy to bring back our foreign national program, but we brought it back differently, and we brought it back under this investor cash flow program. So in addition to your regular eligible borrowers, we can actually do foreign nationals under this program. So again, it's not an income-based program, so we don't have any of that, those issues. Typically, of course, a foreign national is somebody who is living outside. Do you want to switch the screen to the bullets on there?
I was getting into the questions coming in. Keep the questions coming, please. And yes, this is being recorded. Sorry, Denise.
All right. So point. I'm sorry. You good? All right.
Yep.
So the maximum LTV on this program for foreign nationals will be 70%. You know, the loan amounts are still the same. So 75,000 is the minimum loan size and $1.5 million. So the only thing you're seeing different here is just a slightly different LTV. You know, we're not going to allow anybody from any sanctioned listed country. And there's one county in particular in Florida, I believe it is, that we're not going to be lending in. We've got some issues there. Yeah. So just so you look, there's going to be a certain eligible visa type that the borrower would have to have. These are the list down here. And the only difference is the reserves. So the reserves are really 12 months reserves required to be in a U.S. bank account for at least, and we have to have the funds for, we look back 60 days, but they have to be seasoned in a U.S. account for at least 30 days. So this is a DSCR program, so it has to have a 1-to-1 ratio, so the property does have to debt service. And the way you, just in case I didn't touch on it before, in order to calculate the debt service, you're basically taking the market rent at 100%, and you're dividing it by the pity bank. So it's the monthly rent at 100%, there's no haircut, and you're dividing that by the pity payment, as long as it is 1 or higher. So if the rent is $1,400 and your pity payment is $1,399, you're good to go. So that's it. There's no gifts allowed. Again, we're looking for seasoned funds for 60 days, which is very different than our standard seasoning. And something to point out, our programs will only require 30 days asset seasoning. So we're only doing a 30-day look back on most of our programs. On this one in particular, we are going to be looking back 60 days, making sure that we have funds in the U.S. for at least 30 days. So the only other requirement that is very important, and we've implemented this because of maybe some issues that we've had in the past with our old program, but it's going to be very important that your borrower understands that we are going to have an ACH auto payment, and that is a requirement for this loan. So we are going to be taking automatic payments. We noticed in the past that we were having problems with receiving payments with the mailing from outside of the countries and this and that. So this is the easiest way to do it, and it is a requirement for the loan. Cannot be
so
waived.
Andrew, hopefully that answers your question. You know, we're you know, that was a big question there, Denise. So thank you for answering that. Hey, I know we're getting 20 minutes to the top of the hour. So again, all questions will be answered. This is being recorded. So we're going to, and then the recording will go out before end of day tomorrow. So Gary, let's go on and talk about some of our full doc programs, and you're going to talk about our platinum program.
So the Platinum Jumbo program is a great program for folks who need a jumbo loan who don't qualify through conventional means for one reason or another. So we do loan amounts up to $3 million, starting to $250,000 loan amount at the start. Some of and we'll go to 95% loan to value, up to a $2 million loan amount if you've got a 720 FICO score. So that's another recent change that we came out with several months ago, where we used to have a max LTV of 90%, but we've moved that up to 95%. And once again, that comes with no mortgage insurance. So where you find some opportunity, I believe, with this loan is we only have a 4-year seasoning requirement for any type of housing event. By that, I mean foreclosure, short sale, deed in lieu, or the discharge of a bankruptcy. So it's only a 4-year seasoning requirement. Another place where you'll see opportunity is our expanded debt ratios, right? So if you've got a 90% LTV or less, it's a 40% front, 50% back. If at 95%, we still allow you to go to a 45% back end debt ratio. And we do all occupancies. We do all transaction types, purchase, cash out, rate, and term. We do the 40-year interest only as well on this. But it is a great way to get some of those jumbo borrowers qualified that maybe for one reason or another don't qualify. And another advantage too is 6 months reserves. We talk about reserves. If you do a $2 million loan and a lot of other places, they're going to require a lot more than 6 months reserves on the subject property and reserves on additional properties. So it's just a 6-month requirement on the subject property. So those are the places I think you find some advantage with this program. Large loan amounts with some aggressive underwriting guidelines.
Yeah, great point, Gary. And that 95% is key for a jumbo loan, and only putting 5% down with no MI. Really key component there. Denise, we're going to jump ahead to the other full doc program, and let's talk about our Portfolio Select and why people would differentiate this from our Platinum.
Absolutely. The Portfolio Select program goes up to 90 LTV with no MI and is starting with scores as low as 600. Loan amounts up to $2.5 million, but here's the key. It's 1 year seasoning from any housing event, foreclosure, short sale, or deed in lieu. So if you want better rates, slightly better rates, you're going to be looking at 2 year seasoning, but we will do a minimum of 1 year seasoning. So that's what really sets this program apart. We're looking for somebody who's reestablished themselves since this foreclosure, short sale, or deed in lieu. But again, we're looking at 12 months seasoning on that. We're going to do the same 1 to 4 family, second homes, investment properties, condos, non-warrantable condos, and we're going up to a 50 back-end DTI on here. We're also still allowing the 40-year fixed interest only. And we also do allow gift funds here. We do want the borrower to have at least 5% of their own funds into the transaction, and we're still going to have a reserve requirement. If it's a cash out loan, again, you can use the cash for to satisfy the reserve requirement.
Yeah, Denise, I think the key you just hit on, which I like, we haven't mentioned before, is, you know, maybe this borrower only has 5% of their funds. Don't say no. Talk to your account executive. We do allow 5% from a gift fund from a family member. So I think that's key. And I think the other key to this program is, you know, let's get this borrower. Maybe something happened to them during COVID, and since they've found something, you know, really positive going on and in a new job, get them back in home ownership, and then you could go 2 more years, refinance them into our platinum program, or, you know, 2 more years after that, and you're refinancing them into an agency loan. We know the house is going to appreciate, and we know their credit. You're going to work with them hand in hand to make them on the path to a better credit. So, you know, these are the loans. We used to call them 2-for-1 loans, that you close this borrower in a Portfolio Select, refinance them into a platinum, and then down the road, you're hopefully refinancing them into an agency loan. So anyway, I know we're moving along. We've got 15 minutes to the top of the hour. Gary, we're going to touch on our asset qualifier program, if you don't mind, please.
So I like this program a lot. We talk about this program an awful lot here, and this is a great program for somebody who's got significant liquid assets, but really doesn't have a source of income. And they can qualify for a purchase refi of a primary residence up to 75% loan to value. So it is great for someone that's, say, maybe retired and has significant assets, but just not the income, maybe sold a business, whatever. They have the assets to back it up. I used to refer to this borrower when I talk to people, I would say, you know, this is kind of a unicorn type borrower, right? I mean, you may run into it once in a blue moon. It's not going to be your everyday customer. They just don't have people with this, you know, form of assets. However, as I was talking the other day, I've been here 6 years, and in the last 6 or 7 or 8 months, I've seen more asset qualifier borrowers than I have in the previous 5 years I've been here. So they are definitely out there. So what are we looking for? So it's no income, no employment on the 1003. It is for a primary residence, which is fantastic. So there's no debt ratio. The assets that we're using for qualification only have to be seasoned for 6 months. We used to have a requirement for 12 months, but it's only 6 months sourcing and seasoning of funds. 5 years from a housing event, like a deed in lieu or a foreclosure, 5 years from a bankruptcy. And the minimum requirement is this: it's 5 years, $500,000, and that's the minimum requirement, $500,000 post-closing assets available to them. It could be more than that, but $500,000 is the minimum. And what does that entail? All right, so the required assets for somebody to purchase or refinance is you have to be able to cover the loan amount with your post-closing assets. You have to have 60 months, 5 years of coverage of recurring monthly debts, funds to close, and 6 months PITIA in reserve. So it's minimum 500, but it could go up from there depending on the loan amount that you're taking out and the amount of recurring debt that you have on a monthly basis. So we can use your stocks, your bonds, your mutual funds. We can use your IRAs. We can use your 401ks. We get very aggressive with that. Your IRAs, we can use either 70 or 80%, depending on whether or not you're 59.5 years old. So this is a very aggressive program for folks that have money, but they don't show a lot of monthly income, and this no income, no employment on the 1003. I had one recently where, and this is a good example, I think, of, when you think of this, I had someone who was a dentist that owned their own dental practice. However, a year plus earlier, they had sold their dental practice to someone for, it was about $5.5 million they sold it for, went back to work for that business as a dentist, was making about $130,000 a year in salary. We took that off the table because of the assets they had in the bank. They wanted to buy a $2.5 million property. They weren't able to do that with their salary, but because of the assets that they had from the sale of that business, we were able to close that loan with no problem. So that's a real life example for a loan we just closed a couple of months ago.
Yeah, Gary, you just answered about a half a dozen questions with the assets that we were able to use. So I appreciate that, between IRA, stocks, bond, all that stuff. So thank you for covering that. Denise, anything else to add here? I think you had a funny story the other day.
Well, yeah, actually my first, and I know this is so ridiculous, but my first closing here at Angel Oak was an asset qualifier loan, and it was delayed financing. What happened was the borrower was having a difficult time. Again, it was somebody, I believe, sold a business, now was like, an employee of that business or consulting. So things had changed. So the loan officer was really troubled because, she wasn't qualifying, but she had several $1 million in the bank. So what ended up happening was she panicked because she wasn't getting her commitment in time. It was a Florida purchase, and she went ahead and she liquidated money and she paid cash for the property. So I get the call and I have to jump in, and we have this whole issue with, she can't go full doc, this and that. And I said, what does she have in the bank? And we took a look at the assets, and I was able to actually give her a loan and recoup her assets, like as if we were doing a straight purchase. 30 days, I think we closed 30 days after she had already paid cash for the property. And I was able to close this just based on assets, no income, no employment, no debt ratio. And it was a lump sum delayed financing. So when I closed that loan, it was my first closing. I knew I had made the right move to come work for Angel Oak. I was like, if they're doing this,
That's
I made
amazing.
the right move.
That is an amazing story. I love it. One of the other questions came in here. I can answer that. Can we use like hard assets like properties and stuff like that? Unfortunately we do not. But Gary, went through all the. I'm sorry, Gary. Did you want to add anything?
No. We also have a calculator that we have where you just have to plug in the pertinent information with the types of assets, where they're coming from, their age, the recurring debts, and so forth, and you can find out in 10 or 15 seconds whether or not they qualify for the loan. It's fairly easy.
Right. If somebody sells a property in order to buy another one, although we cannot use the assets from the sale for the qualification purposes, we can use it toward obviously the down payment and closing costs.
Great point, guys. Mm-hmm. So we're 10 minutes to the top of the hour. I think Denise, you're going to take me through a lot of you have asked about rates on these programs. So again, our website's really easy to use. Right up here is our non-QM quick quote, and I'm going to have Denise take me through a couple of scenarios here. So Denise, give me a couple scenarios that you want to show some pricing on.
Yeah, this is important, and flag this and make this your favorite. Angel Oak has fantastic rates, and we're proud of that. But we also want you to have the ability to price something really quickly for yourself if you can't reach your account executive. And this is not only is it just a pricing tool, but it's intuitive. So if you keep flipping around scores or loan amounts or something like that, you're going to keep being able to. It's going to keep updating for you. So let's do a bank statement scenario, because I know that that's such a popular product. So let's just say you have a guy, it's a great loan, it's $750,000. Let's put that in there, 750. He had great credit. He came to you as like a 740 score. So we're going to put 740 to 759. The loan to value was great. He was putting 25% down. This was an excellent borrower. Everything was good for single family. It was a purchase. And the only issue is you got his tax returns, and unfortunately they just didn't show enough. So you're panicking, you're calling your account executive at Angel Oak, and I say, hey, get me 24 months of his business bank statements. And you say, okay. And all of a sudden we get, we still have a deal. So at this point, your par rate is 3.875. This is the only requirement here is that your borrower has not had a bankruptcy or any type of housing event, which I would assume he wouldn't, because of this, obviously prior to this, he was probably DU approved. And all of a sudden your tax returns came in lower than expected. So the first thing you want to do when you get that, you quickly look at their gross receipts, because that gives you kind of an idea of what we're going to see in the bank statements as far as cash flow. So let's just say this is your par rate, and you could also build in compensation as well if you're signed up for lender paid comp. So it's 2 years from any housing event and 24 months from bankruptcy. I don't know if you could slide, so I don't know if everybody can see the full screen here. I know I'm missing the end side, but it's 6 months of reserves on this. So also too, so let's say you have, he just wasn't sure, but he wanted to maybe put 30% down. John, flip that around for us, just see if we can just lower that.
Yes.
And I'll lower that. You can see, all right, look, so 3.75. What I like about the tool is that you can adjust the credit score. So let's say you have somebody who's kind of right on the cusp, and you want to see whether it's worth doing a rapid rescore. I mean, obviously a rapid rescore can take anywhere from a week to 8 days, 10 days, whatever. You want to make sure that it makes sense of whether it was worth it to do. So let's say this guy had a 757. You're like, well, what about 760? Would that improve my score? And you take a quick look and you say, you know what, I don't know that it's worth it. It's an 8. But in some buckets, you're going to see a substantial difference. Also notice too, like, maybe you're coming to me for a 90 LTV, but always flip it down to 85. See if maybe they can get a gift, because the pricing is always going to be substantially better from, 85 versus 90. So you're looking at rates in the 3s and low 4s for somebody who has literally been turned down. You're going to notice with these non-QM customers that they've been turned down by banks before, and they are, they're just very relieved that they can get the home that they want, or that they can get the equity out of the home. Maybe their kid is going to college. Believe me, it's not a rate issue with these customers. They've been turned down. So understand that they're going to be very, very happy when you present them with a loan approval.
Yeah, Denise, and the key to this is a 30-year par rate. No MI on this 90% LTV. You got 4.375, no MI. I always listen to one of my other account executives talk about, tell them to go to their CPA and ask them what this rate looks like, because, they'll tell them, should I write off another 30, 40, 50, 60% on my taxes, or is it worth paying an extra couple $100 and a payment on a monthly basis? And the other thing Denise touched on is these borrowers, they're resourceful. They are self-employed borrowers for a reason. So if you decide to pass on them, and I forgot what our number was it 69% have not done a bank statement loan in the last 12 months? If you pass on this borrower, there's 31% that are going to get it done. And if they don't reach out to those other loan officers that have closed those loans, they're going to reach out to us directly. So they are going to get done. I promise you, you will lose a referral source by not doing this loan. And these borrowers all are self-employed, and guess who they know? They know other self-employed borrowers. They're going to be your biggest referral source. Denise, let's take them through because our second most popular program is our investor cash flow. Let's take them through an investor cash flow, and then we'll go on to how they can find these borrowers.
Okay. So let's do an investor cash flow loan. Borrower comes to you, owns a primary residence. Maybe even this is a first-time investor, but he's looking at a great 2-family. Property is worth about $550,000. Let's say the loan amount's gonna be about $550,000. He's got good credit. He's got a 740 credit score. He's putting 25% down. It's a purchase. We're gonna change it to a 2-family.
Okay.
And we're going to change the bank statements to investor cash flow.
Yeah, you have to make sure you click on investment property. So, and so here, go ahead,
Look,
Denise.
you're looking at a rate right here for a two-family investor. This is somebody with no landlord experience, but they want to get in the game, and it's 4.625% on a 30-year fixed. As long as this borrower hasn't had any type of bankruptcy or housing event in the last 4 years, we're good to go. So again, this 1003 is coming over to me with no income, no employment, and just make sure that your borrower has the assets. Keep in mind, your borrower can use business funds also as assets here. Just make sure that the borrower owns 100% of that business. It's very important. It's an investment loan, so we are not taking any type of gift funds on this. But this is great. So change it. Even if it's a 3 or a 4, this pricing is not going to change. So you're still getting the same rate up to a 4-family. If you want to do a single family here, you can. You'll see that there's a little bit of a rate difference.
So this borrower, Denise, is not coming to the loan officer with 1.5 feet of tax returns, right?
Exactly.
Even if they
Exactly. With multiple LLCs and business write-offs. And, that's usually what you see when, what's the worst thing that happens to a loan officer? They get that call and it's like, yeah, well, I got 7 different companies and, you get those complicated tax returns. This is a slam dunk. These loans are done in 30 days or less. Realtors come to us with this. How many times do your realtors go out into, they see a property, it's like, oh my God, this is great. Again, most realtors write off their income as well. So they can do it. The difference between this loan as an investment property and even flipping it to a bank statement, John, if we want to do that, you can see in a lot of cases, it's going to be a slight rate difference, to go from a bank statement investment to or a 1099 investment to a investor cash flow. So sometimes, just for argument's sake, for time, just utilize that program.
Well, Denise, that's a great point. You brought up how easy these loans is debt service coverage loans are to close. You can close them in 20 days. Now, granted, the appraisals are where the lag and where the rubber's hitting the road, but I mean, that's your biggest issue. So a couple other questions here. Martha closed a 90% bank statement loan with us and asked about escrows or impounds. Yeah, anything over an 80% LTV, we are going to require that the borrower escrows. So, but Martha, thank you for closing a loan with Angel Oak. We really do appreciate it. And then,
but we will allow an escrow waiver for LTVs 80 or less on certain borrowers.
And there is a price and adjustment for that. So, and then the other question was about the rates. Those rates are par rates, and the way you can get, obviously you want to get paid, and whether it's lender paid compensation, you would add a 0.5 point to get a point back in lender paid comp. So it's a 0.5 to 1 ratio there. So you add a 0.5 to the point to get 1 to get 2, and continue the math down the road. I know we're getting close to the top of the hour. Would it be, Gary, I don't know if you had anything to add regarding Quick Quote?
No, I think this is a great tool to use. It's easy to use. You get a lot of questions about, what's my rate? What's my maximum LTV? You can find that out in less than 10 seconds when you're on the site. And it's really user friendly. And this is where you go if you want to send Denise or I or any of your account executives. This is where you go to send a pre-qual, a quick qual to us. You click that little blue select button. It takes you to step 2 and to step 3. And step 3, you upload all of your 1003, your credit report. If it's a bank statement loan, all your bank statements get loaded there, and we take it from there. So, yeah, and John was just talking about when we, pricing a loan. When we price out a loan for you, and we do a quick qual and send it back to you, every company that has a wholesale agreement with us has a built-in compensation plan. So when you get the approval back from us, the pre-qual, you get all of your options, borrower paid and lender paid, right there. So all you have to do is select which option you want to run with.
Yeah, great point. Great point, Gary. And so, everyone's always talking, how can I market? How do I find these borrowers? So we're just going to log in now here. Unlike our Quick Quote tool, you don't need login credentials, but here you do. I'm gonna log in here because I timed out. So you're always asking, where can I find these borrowers? How can you help me grow my business? So this is our portal here, and hopefully you guys can see this. Gary, take us to some of our really cool marketing initiatives here?
Yeah, so I'm having a little trouble seeing it, but if you would, for right here, if you could click on the flyers section for me, I don't know if you did that yet, but if you could, that would be great.
Yep.
So in the marketing portal, this is a great way, and I talk to loan officers all the time about this. If you're calling on agents, builders, this is a great way to get your foot in the door, to differentiate yourself where everybody else is calling on their agents and talking about some vanilla programs. This is a great way to go and kind of, cut your own path. So, and it's a great way to get your foot in the door. So if you could click on the bank statement one there, and one thing that I'll just bring up, when you get your login credentials from us, and it's easy to get them, you get them in within 24 hours of requesting them. When you log in, this will all be populated for you with your contact information. All you have to do, if you want to drag your picture, your logo in there, you could do that. It says absolutely nothing about Angel Oak on this flyer, and you can use this to market all the programs that we talked about today. It's a great way to get your foot in the door. And when your foot's in the door, you can ask for the rest of the business. This is actually very, very slick, very professional flyers that you can use to market with.
Yeah, and then Gary, some of the other things we have, social media here. So you could I'll bring up a bank statement for just the social media. Go ahead, Gary, if you want to just touch on any of this.
Yeah, so we are very savvy when it comes to using social media to help you market. And like I said, these are all available to you for you to use with your own social media to get the word out about what you're doing and how to differentiate yourself from your competition. So it's all user friendly. And if I could pull back for 1 second too, from this, I'm sure I speak for Denise and all the other account executives that are out in the field too. We also love to do lunch and learn. So if anybody out there needs somebody like us to come out and just be with you in the audience when you're presenting this stuff, we're more than happy to do that as well.
Yeah, Gary brings up a great point, and another presentation that we do have. It's our Realtors Untapped Market, and I will speak on behalf of Gary and Denise on this because I've done these in the past. I've been on these in the past. If you are a loan officer looking to grow your business and increase your referral source, this presentation is the most powerful. And as Gary said, they love to go in the field and present on your behalf. They don't say anything about Angel Oak. They just say, I'm one of your investors that you have access to. And I promise you, if you get 10 realtors in a room to present to them, one of them will want to close a loan with you, or is going to say, hey, I've got the exact borrower for you. If you can get 10 realtors in a room, I promise you, you will get their business. And most of the times it will be their loan, personally, as bank statements or as a debt service coverage program. So that's where you go. Edmondo, you talked about, I know you work for a big national lender. We will get you your login credentials to get to this. You got to make me a promise you're going to use it, because this is the most powerful way to increase your business. So guys, we know we're a couple minutes past the top of the hour. We want to be really respectful of your time. This is being recorded. We will get this out to you before end of day. But before I say goodbye, Denise, how about a last parting word or two?
I think it's really important that you just understand that we don't expect you to, when you see these programs, we don't expect you to know all the ins and outs. That's what we're here for. And we want you to push back on us, and we want you to create a relationship with us and allow us to help you pitch these programs. You're going to need the basics to present them to your partners, but at the same time, we're here to back you up, and you have to understand that this is all we do day in and day out. And we know these products like the back of our hand. And we also, we've been working here long enough to know what's going to fly and what's not. And you know what? We're not the type of account executives. We're very seasoned, and we know that a quick no is sometimes just as good as a yes. And we're not going to drag you through the mud. When we give you a free qual, we want you to feel confident. And again, we're here to help you pitch these products. So this marketing is excellent, but we're also here to help back you up with any questions that you have. And even if we can't attend a presentation, I've had referral partners call me and keep me on the line. where I've been able to listen in and jump in where I could. So again,
yeah, Denise is fading out there a little bit, but what she's saying is obviously we'll do it with you in person, or we'll do it with you via Zoom call, webinar, or anything. Gary, last couple of departing words here.
Sure, I'll keep it short, but the surveys that we did when we started the presentation here. So one group, 29% did investor cash flow, 31% did bank statement, which means the vast majority of people have never closed one of these types of loans. So the market is changing a little bit, and it's going to change a little bit more going into 2022. Rates will trickle up a little bit, refis will slow down somewhat. This is a great opportunity to allow you next year and the rest of this year to say yes to more business, right? To make sure that you're not leaving a loan on the table. If it's a bank statement loan, if it's a debt service coverage ratio loan, they're out there. We close these every single day. And it's very easy to work with us. And it's just going to be a nice add-on and supplement to the business that you're already doing.
sure.
Yeah, Gary, well said. Just some statistics here. The Mortgage Bankers Association is expecting refis to decrease by 62% next year. Purchases are supposed to go up 9%. And Gary touched on this, whether it's 60% or 70% of you have not closed a loan, a non-QM loan, or a bank statement loan, or an investor cash flow loan. The biggest reason you haven't done it is because you're not familiar with the programs, or you just don't feel confident in closing these loans. You can see we've got Denise, great experience, knows she's walked in your shoes. We've got Gary, almost 30 years. Sorry, Gary, I'm not going to age you. Almost 30 years of experience in this industry. We will help you close your loans. Martha's closed a loan with us, one of our customers here. So, guys, we're going over, but thank you for your time today. For those of you who have closed loans with Angel Oak, thank you for your business. For those of you that want to close loans with, please reach out to us. We will hold your hand through the entire process. Thank you for joining us today. We hope to be working with you in the future. Have a wonderful week. Thank you.